Welcome to the live economic and financial markets commentary. This live session will cover fundamental analysis in the week ahead, global coverage of current economic data, including major markets news, analysis, and events, and how to apply the best trading strategies prior to news being released and after. First, I'd like to start the session by giving you some information about me. My name is Ehab Gubil. I was born and raised in Egypt. I have a passion for financial trading as well as teaching. I have been trading for a number of years, mainly on Forex and commodities. And in recent years, I have also set up my own trading robot signals and website. I host online webinars and seminars on investment and financial trading regularly, and I provide my service to subscribers worldwide. Now is the key highlights of the week ended July 24. Athens took another crucial step towards a bailout after Parliament approved a second set of reforms. The passage of the measures means that talks on an 86 billion euros bailout can begin. Meanwhile, S&P said it believes the possibility of Greece exiting the Eurozone by 2018 has declined to less than 50%, but the risk is still high, particularly if Athens does not successfully implement the rescue program. In the UK, Bank of England policymakers voted in July to hold the central bank's key interest rate unchanged. Minutes of the MPC's July policy meeting showed all 9 members of rate setting board voted to keep the benchmark interest rate at a record low of 0.5%. The time for an interest rate hike is approaching, and it is highly likely that rates will continue to rise over the next few years, as Bank of England policymaker David Miles said. He said the time for an interest rate hike is approaching, and it's highly likely that rates will continue to rise over the next few years. In Australia, RBA Governor Glenn Stevens said an interest rate cut remains on the table. The Australian dollar has declined to around 0.65 US dollar recently, and the RBA lowered borrowing costs twice this year to historical low 2% as it aimed to accelerate a transition towards service industries and manufacturing as a decade-long mining boom fades. In New Zealand, the RBNZ cut interest rates for the second time in 6 weeks and hinted further easing will likely be needed to underpin inflation as growth slows. Central Bank Governor Wheeler is trying to stop inflation from near zero to 2% as target. Economists now expect the RBNZ to proceed with cutting the official cash rate in the near term to help jumpstart consumer inflation. In Canada, the Canadian dollar only managed to close flat against sterling last week, finishing the week down against all other major crosses. Weaker oil prices and a gloomier outlook for the economy are to blame, with positive retail sales failing to change sentiment. In emerging markets, in line with expectations, markets concluded the week suffering losses with a combination of alarming data from China and resumed selling in commodities, weighing heavily on investor sentiment. It is the combination of the threat of slowing trade from China, the price of commodities having not yet found a floor, and the expectations for the Federal Reserve to begin normalizing monetary policy that are behind this suffering, and with these threats showing no signs of going away. These currencies are still exposed to further loss and further loss. The FOMC sentiment could be a key driver this week if any further clues for or against the famous rate rise are presented. The Federal appear to be more hawkish in recent weeks, but this is at a time when global growth continues to fade. Oil prices fall further, commodities are within a bear trend, and further evidence of a China slowdown make it an environment difficult to justify a rate rise. If the statement fails to deliver, then GDP figures on Thursday are another one to watch. GDP for the second quarter is forecast around 2.6%, but the markets are still aware of 0.2% printed for the first quarter. This week, we will also watch these events, all in London times. We don't have high impact news on Monday. Tuesday, 9:30 a.m. UK quarterly GDP. 29th, 7 p.m. US FOMC interest rate. Thursday, 1:30 p.m. US quarterly GDP. And Friday, 1:30 p.m. Canada gross domestic product. I will talk in more details about some of this news. UK prelim GDP will be released on July 28 at 9:30 a.m. London time. UK prelim GDP is the most important of the three GDP releases since it is the most likely to surprise, with the last MPC minute noting potential hawkish sentiment shift among MPC members. If this release were to surprise to the upside, we should see plenty of market reaction. UK prelim GDP forecast as 0.7%, previously 0.4%. How to trade this news? Our plan will be, since this is the first release of the second quarter GDP for 2015, we are likely to get a huge reaction if we get a surprise, as most first releases are what the market looks to. Considering the recent positive trend in the economic data, we may get a strong surprise release. So I recommend you to be next to your computers and trade this news. However, we will still be looking to trade the release using our after news retracement method. Our surprise factor is around 0.3%. as we will look to possibly sell the pound or make fall or down option at 0.4% or worse, and buy pound at 1% or better. So we will sell the pound against other currencies at 0.4% or worse, and buy the pound at 1% or better. If we get our surprise factor, the market will move more than 50 pips, sometimes more than 100 pips within 1 hour or two, as GDP is a very high impact report. We'll be looking to trade this release using after news retracement strategy. We will wait for the release first, then wait for market spike as first response to this release, and then wait for a decent retracement before entering the market and buying your option. And you can see this is a 1 minute chart for last release during and after the news release. It was expected as 0.4% and the actual release was 0.3%. And because we did not get the deviation number, the market followed the pre-news market condition and cement, and it kept falling down. With US FOMC interest rate, it will be released on July 29 at 7 p.m. London time. US FOMC interest rate decision will be the main focus of the week, with the Federal Chief Yellen again repeating that rate hike should take place in 2015. This release could provide a heads up if federals were to raise interest rate by September. We will definitely pay close attention at this FOMC statement. The interest rate forecast 0.25%, previously the same. We should trade this news safe and only take a trade if we get clear signals. The plan for to trade this release is if federals confirm September rate hike or go ahead with rate hike in this meeting, we will see a strong dollar surge. We will sell euro dollar and buy dollar yen. So if we see in the statement, if federals confirm September to hike the rate or they made it this meeting, we will see a strong dollar surge. And they will make full option for euro dollar and rise or up option for dollar yen. If federals maintain the same tone as last meeting, we will sit on the sideline and wait for the market to make its move first. Then we can decide. There could be a third scenario where the federals could weigh in on the potential for further easing, but it's highly unlikely. Then we should see a collapse of the dollar, and this we will sell dollar and buy euro dollar at the very first chance to get. So we have three options. Federals confirm September rate hike. We will see strong dollar surge. If federals maintain the same tone as last meeting, We will just watch the market and then decide to see clear move. And third scenario is if the Federals could weigh in on the potential for further easing, we should see a collapse of the dollar and we can make our trade depends on that. To sell dollar yen or to buy euro dollar, for example. And we can see in the chart, this is our meta chart for last month during and after the news release. 17th of June, the market just followed the pre-news or pre-release market condition and sentiment because there was no surprise in the market. Canadian GDP will be released on July 31 at 1:30 p.m. London time. Canadian GDP is expected to come in at 0%, considering recent economic data out of Canada and the Bank of Canada's pairs for further easing. I would not go long on the Canadian dollar, regardless of the release, because I don't expect the Canadian dollar to get strong, whatever the release. So how to treat this news? We will look to sell Canadian dollar if we get a minus 0.3% or worse release, or we will buy Canadian dollar. If Canadian dollar, if the release comes at 0.3%. So we'll buy Canadian dollar at 0.3% and sell it at minus 0.3%. Because Canadian GDP figure may be the catalyst. We need to see more volatility in the Canadian dollar. So we will watch this news and I expect high volatility after the release. We can see 1 minute chart for the last release during and after the news release. It was expected as 0.1% and the actual release was minus 0.1%. We can see the market reaction and how the Canadian dollar get weak immediately after the news release, and the market kept going in the same direction, and it was good option for us to buy or to make rise option for dollar, Canadian dollar. So for this release, we will buy Canadian dollar at 0.3% and sell Canadian dollar at minus 0.3%. I want to remind you, if you missed the webinar or want to watch it again, you can watch it at binary.com YouTube channel or at my website gubil.com. So then I would like to thank you for attending today's webinar. We will hold following webinar next Monday. Goodbye and see you next time.